Thanks very much. Good afternoon and welcome, everybody. I'm Deborah Young, the CEO of the RegTech Association, and it is my great pleasure to have you all here this afternoon. Before we get started, I'd like to acknowledge the traditional owners of the land on which we're meeting today and pay my respects to their elders, past, present, and emerging, and also to offer a warm welcome to all of our Aboriginal and Torres Strait Islander friends that might be with us today, and offer a very warm welcome to members of the RegTech Association and our special guests. Today is a very big day for the RegTech Association. We have three core strategic objectives, and the first of those is to advocate for RegTech. The second one is to create opportunities for export and new markets. And the third one, last but certainly not least, is encouraging investment into the industry, and that is why we are here today. So many of you will know that I spent nearly a decade with investors in my former role at the Australian Investment Council. So today really feels like a bit of a coming home for me of sorts. And this is our first investor edition of RegTech Edge No Borders. Now, some of you may have attended those programs in the past, which are essentially a showcase program. And these are a way that we can show what the true opportunity is for RegTech to the customer base. Well, today we've given it a bit of a twist, and we are featuring investors today who will be coming along to pitch their thesis and what they look for in an investee company. And we have some different kinds of investors also here, some traditional and some not so traditional. This program has been a hotly contested ticket, so much so that we've created a second program with a different range of investors. And I might say that the second program already has a global investor. So I would say for the investors on our panel today, you better get into RegTech nice and early because there's lots and lots of interest. So that's my call out to you. I was really pleased that about 60% of the audience today are RegTech firms. My call to action for you, if you're a RegTech, today is your opportunity to make connections. Having capital investment is a long game, and one that you need to start making the relationships. No matter whether you're fundraising or you're not, you need to have those relationships throughout. Come here today, learn, connect, and make sure that you carry this conversation forward. As people were registering, there was an opt-in on whether you would like your details shared with the investors. If you've had a change of heart, if you opted no, but if you've had a change of heart, please do pop your details into the chat function so that we know how to find you. Today, we're going to have three parts to the presentation. The first one is we're going to do a little bit of a talk through the current VC landscape, the different kinds of VC, and also a discussion about equity. And then we will have 4 presentations from 4 investors, and then we will cap that off with a Q&A session. So a couple of housekeeping things, if I can, up front. If I could ask everybody that is not presenting right now to turn your camera off and put yourself on mute. That will help preserve the bandwidth for the session. And we'll invite you to come back either during your presentation or for the Q&A. And speaking of which, the Q&A we will curate over the chat function, please. So if you have a question, please say who you are, identify yourself, say who you are, and then also let me know who your question is directed to so that I can do that most effectively. The session today will be recorded and will be made available as a resource after the event. And if I could ask the investors to keep to their allotted time slots of 10 minutes, at about 9 minutes, I'm going to make some kind of noise that will indicate that you need to wrap up because we don't want to squeeze the last presenter, and we want to make sure that we've got plenty of time for questions. But without further ado, I am going to introduce you to Clayton James. Clayton is a partner with Herbert Smith Freehills, and he advises on public and private M&A. and business and asset sale transactions across a wide variety of industries. And he's going to do a little bit of scene setting before we get underway with the investors. So without further ado, welcome to the virtual podium, Clayton. Thanks very much for being here.
And thanks for having me, Deborah. An absolute pleasure. So today I'd just like to run through a couple of pieces in the RegTech space. So what we'll do to start off with is just to give you an idea of the industry itself. So the size of the industry, the capital inflows that are coming into the industry, as well as where the money is being invested. We'll also look at the types of investments being made in the VC space. And lastly, we'll just touch upon some of the, I guess, some practical tips, I guess, from our side, I guess, from the legal side that we can kind of share with the founders and the investors. So in terms of the size of the industry, last year was an absolute ripper for the VC industry. So VC managers obtained about $1.3 billion of committed capital in 2020. That's compared to around 700 in 2019. So roughly double the amount of capital is flowing into the industry compared to 2019. And that's been driven by the global acceleration of digitization trends and overall investment in tech, as well as great macro settings. In terms of deals being done in the industry, about $2.4 billion worth of investment was made in 2020. This is versus about $2.3 billion in 2019. There are a smaller number of deals in 2020, indicating that the check size being written by investors are slightly larger. So yes, to answer the question, these are the Australian stats. So this is just Australia, and this is taken from the Australian Investment Council's 2021 yearbook, which has just been released. So in terms of the life cycle of venture, I guess the way we see it is you have your initial pre-seed investment. So this is the initial working cap that you will have as a company. So this will usually be from family and friends, and I don't probably need to tell the companies this, but also credit cards and whatnot are being used to establish the company. The next stage that we see is a seed stage, and again, family, friends, credit card, but also the emergence of the first professional investors, being the angel investors at the seed level. Once we've reached a bit of a validation of the business model, and there's been some early customer engagement, we see the Series A investment. So we see here the specific VC investment funds, family offices, potentially some US VC investors, and potentially some corporate VC investors. And as we move into the next series, so Series B, C, and D, this is kind of driving the rapid expansion of the business and also the push into other markets. And the same investors we do see in the follow-on seed raises, but also more likely to be US investors at this stage. And also, we also do see the PE house investors come in at generally the later stages as the business has been somewhat de-risked. And so each one of those we refer to as a non-control deal. So that is that no one controls the company apart from the founders, generally at that stage. The founder does get diluted as the business does take on new investment. And then eventually you may see an exit by the business as a whole by way of a trade sale or some other buyout. And that's basically a very simple snapshot of the life cycle of a business. So in terms of the numbers of the deal, again, this is taken from the AIC yearbook. So as you would expect, the highest number of deals is at the angel or seed level, so around 30%, around 25% at the Series A level, 10 at Series B, and 10 Series C, and around 1% at Series D and later. But obviously, as the number of deals drops, the value of the deals increases. So the value of the investment being made by the VC investors increases. And I guess the other question is, where is the money going? So at the moment, IT is still receiving the lion's share of investment in the VC piece. So around 50% by number and around 40% by value. But financial services are around 15% by number and almost 40% by value. So a lot of value is flowing to both IT and the financial services industry. So that's just a very simple snapshot of the basic building blocks of the industry. And I just thought it might be worth spending a little bit of time talking through the equity investment process. So at its simplest, the equity investment is simply an agreement between the company and the investor to invest money at a given price. Typically, we see at the seed and pre-seed level ordinary shares being issued. And once you get into the series raises, so series A, B, C, D, typically we see, although not always, that preference shares are being issued to the underlying investors. And the preference is really in relation to if there is a winding up of the company, the last investor gets the money out first, and then that goes on until the money is usually gone. Typically, what we do see though is the investors converting their shares into ordinary shares and then participating in the exit process, assuming that the company has done well during that process. And what we see is generally the deal being done, what we say by the term sheet. So the term sheet is usually described as a non-binding document, but just quickly running through the various headings. So you'll have the initial subscription amount, you'll have an agreed value of the business and the amount that's been contributed by the investors. You'll also set out the steps that need to be required to be completed to close the relevant fundraising round. The types of shares that are being issued, so that is an ordinary share, is a Series A preference share, it is Series B preference share. Governance, which we'll touch on a little bit later, but which is one of those core aspects. So typically what you would see is during a funding round, the lead investor, although not always, has a right to a director appointment right to the board. The other governance pieces we generally see covered in the term sheet is any veto rights being issued to the investors, at what level those veto rights apply, and the sorts of things that those veto rights apply to. Usually there's a restriction on dealing in the shares that have been issued until certain events occur. And then there may be some other mechanical provisions added to the term sheet. Usually it's expressed to be non-binding. There may be exclusivity provisions, and it may apply for a certain amount of time. So having quickly rattled through a large amount of information, the last couple of things I'd just like to touch on is some of those things to keep in mind during the fundraising process. We typically say that during the capital raise process, what you're actually solving for is not this raise, but the next one. So making sure you place yourself incredibly well for that next raise and making sure there aren't any impediments in the documents or how you've done the raise that may cause an issue down the track. So one thing just to touch on there is cap table. And I guess what we are seeing in practice is a tendency towards founder vesting. And I guess what we mean by that is simply that the founders have a certain amount of equity and that vests over a given time period. And I guess the reasons for that are a couple, but primarily what it is being done for is this, that sometimes when the later stage investors look at the cap table, they'd like to be reassured that the founders are receiving their fair stake of the business and own that fair stake of the business, are going to be rewarded for the performance of the business. So I guess what they tend to look at is if there's a position where the founder doesn't have a large enough stake in the business, and they'll look at the cap table to establish that. So I guess what we do see in practice is seeing that with the founder vesting, that if a founder does leave, and noting that there could be quite a number of founders in the business, that if the founder does leave, that there's a right for those shares to be acquired by the business. And that means that you kind of move away from this deadweight capital from having founders who have been in the business, who exit, who leave and making sure that they don't leave a bit of a hole in the cap table. So that's one thing that we hear from the investors that they look for. Other things just to quickly touch on, usually the business will be founder dominated, and so that the founder will own most of the equity, and the founder will then, given that the investors will generally have an appointment right to appoint a director to the board, but also have negative control. So they have veto controls over the business being able to do certain things. And that's, I guess, a fairly standard part of the investment model that we see. And then in terms of anything else, a couple of other things apart from that governance piece and the cap table is making sure that during the investment stage that the business is set up correctly. And so generally what the investors will look at is a fairly targeted and important due diligence exercise on the business. So the sorts of things I'll typically look at is IP ownership, making sure that the critical IP is owned by the company itself as opposed to the founder. They'll also look to see the employment terms to see how the founder is engaged within the business. They'll look to see the privacy and data policies of the business. And last but not least, terms of trade. And I guess what investors typically look at here is if there's a critical contract, they'll look to see how that contract is drafted, any change controls of the founder and exit of the founder, how that impacts upon those contracts. They'll also typically like to look at what the standard form of contracting that the business does on. And look, it's fair to say that it's not an overly exhaustive process given the nature of the startups the businesses are investing in, but it is important to do some, typically some due diligence around these areas, but also importantly making sure that the due diligence is done in relation to the management team and the founders as well. So I think that's probably it from me, Deborah. Unless there's any immediate questions, happy to answer those, but I'll just hand back to you.
Thanks very much, Clayton. That was really great. What we will do is I will ask if you could stay on until the conclusion when we will go to Q&A. So if you've got any questions for Clayton, you can pop them in the chat now, and we will get to them at the end. Thank you very much. So it's my great pleasure to introduce Ted Pretty from Macquarie Capital, and I'm very pleased to say that Macquarie Capital are the first investor member of the RegTech Association. So we offer you a very, very warm welcome, Ted. Thank you for being here today with us.
Yeah, thank you very much, Deborah. So a little bit of background. I'm not full-time at Macquarie. I'm part-time or as demand permits. My background quickly was I started out life as a regulatory lawyer, actually, then was on the board of Optus, then executive of Telstra, chaired various traditional companies in Australia, Fujitsu Australia, Tech Mahindra, the Indian software house, RP Data, the property data business, which we took to IPO, NextDC, one of the largest data center businesses in the country. And in addition to being a senior advisor to Macquarie, I'm the exec chair of a small listed security software business, cybersecurity software business. I'm an advisory chair actually of an existing RegTech, is a member of the RegTech Association called SkyJed, which is a very interesting business around Lisa Eisen, who's a RegTech member, is the founder of that business. And also for my sins, a chairman of a startup for my adult sons. And if you want to know which is the hardest job, it's the latter one, because no one wants to listen to their parents when it comes to doing anything, I think. Let me just go straight into what Macquarie looks like in investors. If we can just move quickly to the next slide. Macquarie is an interesting venture capital investor in that it does not adopt a portfolio investment approach. In other words, it's not seeking to have a selection of minority interests in tens and tens of different companies. It tends to try and focus on backing entrepreneurs and who have a commitment to their business, and on the basis that we want every single investee business to be successful for us. That's both an internal approach, which is we make every investment count, and an external approach. Our investment horizon can vary considerably. Average is 3 to 7 years, but some have been obviously less than 3, and some 10 to 11 years to get to fruition. We have noted we're probably not at the premium end of valuations for most of the businesses we invest in, whether it's RegTech or any other, but we try to offer other value as well in relation to what we bring to the table. And the process from inception and deciding that a business is of interest to invest and concluding that investment can vary, but an average of 3 months, and that's because of the processes within Macquarie around the sorts of things that were raised, that Clayton raised around back, obviously the due diligence not only on the business but more important, and the founders, but more importantly on the nature of the market in which the business operates, and that takes that period of time. I would think that the principles of our venture capital group would say that the philosophy has 3 key elements, and that is obviously the investment, which we think is interesting, but it's not the core of what we want to bring to the business. We want to provide side-by-side assistance, and I'll talk about that in a minute. And we also want to leverage access to the broader Macquarie network. So if we do have an investment and we think that investee company has a solution or a service that could be utilised within the Macquarie Group, either in Australia or globally, or any one of the many assets that the group holds around the world in any sector, we try to validate the business of the investee company by putting it in front of those operating entities and indeed the Macquarie Group, including the bank itself. Our sector focus has traditionally been around software and data analytics, digital marketplaces, and particularly businesses that have recurring subscription or SaaS business models. And also we'd like to see that they have the potential to scale, like that scaling either within the market in Australia or particularly offshore. And to give you a bit of a sense around that, we look for businesses that are beyond startup phase. Clearly, we're looking for businesses that are in a mid-range, typically of 3 to 5 million of revenues with serious customers. Having said that, we've actually done greenfield investments because of the resonance that the particular investment proposal has to us, and it may well be that we've already got some familiarity to the sector and the nature of the solution, but also larger business as well. We'd like to make sure that the investee company and the proposition has a particular competitive advantage, something we often call a right of independent existence. In other words, it's just not a bolt-on solution to another application, but it's a business that it is an idea or a platform or a solution or a service that can actually be provided and grow into its own skin as a business. And typically we look for things that operate in one of the areas that are adjacent to the businesses we've already invested in. Now, in the case of RegTech, it is, in some cases, it comes from an enterprise software background. In some cases, it comes from data analytics perspective. So it was this reason that prompted me to push the venture capital group to join the RegTech Association and start to get a better feel for the nature of the businesses that are inside the RegTech Association and get more exposure to it. Now, how do we approach things and what do we help with? Well, obviously, we like to take substantial equity positions. And by that, I mean, we're not interested in minority 5-10% stakes in any one of the series of rounds that we approach it somewhat differently. We're looking for meaningful stakes. And I suppose a good guide to that would be around 25%. But we have some investments in some, for example, some cyber companies in Israel where we're holding 15 to 17%. And we've had investments where we've held over time for a very long period of time where we've gone over 60%. But what it does show is that we do look for and expect to have follow-on rounds of investment as a business scales, and we're not intimidated by that. We don't sit and make the first investment and then sit there whinging or whining about dilution as other capital comes in. Quite the contrary, we like to follow our capital if we've got high conviction about the business. We typically only take ordinary equity. We're not interested in a number of the other what I would regard as sometimes insidious features of the industry, where you're looking for onerous liquidation preferences or control in situations. And we tend to only look to invest via way of, it's usually an ordinary equity. We only tend to invest or provide capital through convertible notes, where, for example, an investee company may be on the cusp of cash flow, being cash flow positive. It needs a little bit of extra cash, either to scale or to get to that point, and we're conscious that we don't want to dilute the founder. At the end of the day, our philosophy has to be that if the founders are successful, then we will be successful, and we want to play the game again. So we don't want to be seen to be rapacious in that way. But by the same token, we typically tend to avoid majority stakes. In other words, something that would give us full control where we would need to consolidate it. So it gives you a flavour of where that might be. I think that it is also, in the cases of most of our investments, we've often invested not the first time we've bumped into the company, but sometimes the second or third time we have, on the basis that some of our capital is used to retire the early seed funders of the business. We like that approach. We have no problem in equity being injected into the business, with a portion of that equity retiring those who took the early seed based risks associated with it. And usually that suits us because we're mopping up the register. We're not interested in having 30 other shareholders, or even more than 2 or 3 to deal with in addition to the founder, because our approach is wanting to sit alongside the founder. In many cases, our businesses, a customer of the business will be Macquarie itself and the group, and provide access to the network. So what does that network consist of? Well, twice a week, a broader group from the VC group that sits on other continents. We get together twice a week and we walk through the portfolio of companies that we either have existing investments in, or we talk about other companies that we're bumped into. And the reason we do that is so every member of the team is across the potential opportunities and can then refer us to similar companies in other markets, similar use cases in other markets for the solutions. And so if you're looking at a regulatory solution around financial products in Australia, you've probably got similar requirements operating in the UK or the US or other similar markets. And so we look for the opportunity to say, well, look, the business today might be small in Australia, but it could be large globally if we give it some support.
Ted, if you could wrap up, that'd be great. Thank you.
Yeah, okay. And the last slide is just, which we've made available, is just a sample across different type of companies, from software and services, data, digital, internet, mobile, and software, and enterprise software, all of which we invested at different stages. So thanks, Deborah.
Thank you very much, Ted. If we can pop questions for Ted in the chat, and then we will curate them after. Thank you very much. Now, Sally from Potentia Capital is going to step up to the podium. Sally's without slides today, so we're just going to be entertained by her lovely face. Thank you, Sally.
Hi. Well, thanks, Deborah. Thanks, Alison, for having Potentia Capital on the panel today. And good afternoon to all of you joining us on Teams. My name is Sally, and I am an investment associate at Potentia Capital, where I work predominantly on finding and evaluating sort of new investments to add to our sort of ever-growing portfolio. My background and life prior to Potentia was in investment banking and corporate advisory at Citigroup here in Sydney. I joined Potentia just over 12 months ago, right in the middle of COVID, and it's really been sort of a journey ever since. So I thought today I might take some time to try and give you an overview of our firm and explain how we might be a little bit different to venture capital, and from that sort of help you sort of see where private equity might work for you in the context journey of your business as you see it. So with that, I guess a little bit more about Potentia Capital and our firm. So Potentia is a Sydney-based mid-market private equity firm that invests exclusively with a mandate in software technology and tech-enabled services across Australia and New Zealand, and only the only one in Australia to do so exclusively. So we've very purposefully chosen this because we are passionate about technology and shaping the role that it will play in the future. So we believe specialisation and sector focus is important. We don't look at everything under the sun. You know, we don't look at some private equity firms will look at chicken restaurants and mining services, but we don't really do that. And as a result, we can really focus on what is relevant to the technology sector specifically, and what really matters to the industry. So our fund is $450 million large, and we are backed by institutional investors, primarily super funds like Aware Super, MLC, ACC out of New Zealand, some names which you might be familiar with. The fund is led by two founders, so Andy Gray, who along his has personally founded a software firm and been a partner at multiple private equity firms, both in Australia and offshore, and has led a number of technology buyouts. And Tim Reed, who was the CEO of accounting software MYOB for a decade. So between the two of them, they really know how to build, to identify, and how to scale our portfolio companies to help them along that journey. Where we differ a little bit, so we seek controlled transactions, generally for companies with revenues north of $15 million, enterprise values anywhere between sort of 50 million to 300 million, with strong growth potential. And so in the fund today, we have 6 platform investments, including, just to mention a few to give you a sense of where we play. We've got a global mining software business, we've got a payments business, we've got an e-commerce business, we've got a property management software business. And this year alone, we've sort of completed 2 new platform acquisitions, and we've completed a bolt-on just as of yesterday, actually. And I'll dive into a little bit of sort of that sort of value that we can help you, we can add to help you expand and grow your business over time, but I can jump into that. So a little bit of maybe where private equity sits and how we might be a little bit different. So much like VC, we are a source of private capital, and we are similar in many, many ways. Often we find that our deals come when founders who have built remarkable businesses want to partially or fully transition out of the business for whatever reason, or recognise that they have pushed their businesses as far as they can on their own and are looking for external expertise and a partner to really scale the business to the next level. So I think there are 3 key differences that I would sort of call out. One is that we back businesses with a proven product and businesses that are generally profitable or have a very clear pathway to profitability in the near term. So as such, I think the consequence of this is that these businesses are generally slightly more mature and potentially lower growth than what VC might seek to achieve their return hurdles. But that is just primarily sort of a risk return difference. The second point is we do seek majority stakes, so north of 50%, which for all of you can be important depending on what your aims are in doing a transaction might be. So if you want to monetize some of your ownership and continue running your business alongside us for a second exit, you can. And a majority buyout makes that cash out potential quite material. If you want to transition out altogether, we have quite a unique operating capability, which I think is quite unique amongst the private equity firms in Australia, in that we back ourselves and we will let you do that if that is what you want to do. So, for example, I will sort of give an example here. Our latest buyout in Newbook, which is a property management software system, one of our operating partners is doing exactly that. And he has stepped in as interim CEO as we search for a permanent CEO because the founder wanted to step out and spend time with his. So that is an option, and we aren't afraid of sort of taking a period of time if that is what is required. And the third point is, I think we seek businesses where we genuinely feel like we can add value through our operational capability with that team that is led by Tim Reed. And we don't get involved in the day-to-day as such, but our operating partners run very closely alongside management teams and are very much a sounding board, and the board provides sort of advisory guidance, plays an advisory guidance type role. And because we work with multiple companies across our portfolio, we see often learnings that are common across many of them. And so there is sort of like a shared learning platform there. And when you join our fund as a portfolio company, we always say that you join the potential family. So I guess we will also help businesses continue to mature in a number of areas. So, for example, one of them is corporate development. So we will help implement best practice governance. HR will help with sort of maturing the finance and tax system, accounting, and all those back office areas that, as potentially founder-led businesses, weren't necessarily the core competency or haven't been at the forefront of where they should be as you mature as a business. The second part is operational capability. So our operating team do help with sort of Salesforce effectiveness, with organizational design, change management, product, pricing, recruitment, and there are a whole bunch of synergies, as I say, across our portfolio where we can leverage parts of one business and put those learnings into another. The third is capital markets. I think we sort of have a bench where we have access to third-party debt. We can help look at capital structures, and we can help you with preparation for an exit, if that is what we choose to do sort of somewhere down the track. We start those preparations quite early on, and we sort of guide you on that journey and in preparation for that day. And by that time, hopefully everything will be sorted and it'll be a pretty smooth process for you. And fourth is probably M&A. We have an in-house sourcing director, Michael Bryan, who I think might actually also be on the call. He works very closely with portfolio companies in sourcing bolt-ons that make sense to help you grow, whether that's in adjacencies or jurisdictional expansion or whatever the sort of aim might be. So, for example, we closed a bolt-on for Micromine just yesterday. We did it with EHG, which is our education business on Double First, which was based in the UK. And we did that with Linkley and Premier. And there are a few examples of that where we have sort of, step changed the platform business with something on top and really taken it to the next step. So I guess hopefully that's helpful from a capital perspective and what we as private equity might be able to bring to a business. So, I guess the message I leave with you is that wherever you are in your journey, you might be there now, you might be there in a year's time, maybe 2 years, 5 years, 10 years, whether you want to transition out or whether you want that external expertise to help take your business to the next level. We are always looking for great businesses to back, and we would love to have a chat to you guys.
That's fantastic, Sally. Right on time as well.
There we
fantastic.
go.
Nice segue. Nice segue. So if we could put any questions for Sally in the chat, and I will get to those at the conclusion of the session. Thank you very much, Sally. So next up we have Melissa Widner from Lighter Capital. So we're going to change gears a little bit, Melissa.
Okay, thanks, Deborah. And I just want to say, I remember when you were starting this, the RegTech Association. So congratulations on all the traction and where you've come today. It's great to see.
Yeah, thank you. Thank you so much.
I am here as the CEO of Lighter Capital, which is the pioneer and leader in revenue-based financing for SaaS companies. Lighter started in the US over a decade ago and just launched into Australia last year. But I'll tell a little bit about my background and how I got to Lighter. So I was an entrepreneur. I ran 2 companies that both had very successful exits. And then I spent the last 2 decades in venture capital, about half of that, a little more than half of that in the US. And previously I ran National Australia Bank NAB's venture capital fund. And Lighter was one of NAB's portfolio companies. So I made the investment. It's a US-based company. I made the investment on behalf of NAB in 2018 and went on their board. And I just love the company, absolutely love the company. I'll tell you why. And when we needed to bring in a new CEO last year, I decided to put my hat in the ring and go back to the operating side. And I'm also the co-founder and chair of an organization that supports women entrepreneurs called Heads Over Heels. And I saw one of our Heads Over Heels portfolio companies on the call here with Lisa Schultz with Verifier. So hi, Lisa, it's good to see you here. So Lighter Capital is, like as I said, the pioneer and leader in revenue-based financing for SaaS companies. So what does that mean? So we provide non-dilutive funding. We don't take any equity. We don't take any warrants. We don't think companies should be giving away equity or warrants when they're taking on debt at an early stage. We look for companies that have recurring revenue, and we'll typically fund them anywhere from sort of 3 to 4 times their MRR. So the minimum amount that we'll provide to companies is $50,000, and we'll go all the way up to $3 million in the US and about $1 million in Australia. And the way it works is we don't ask for, as I said, any equity, no warrants. We don't have financial covenants. There's no guarantees. We're really looking at the strength of the customers, the recurring revenue customers in your book. So it's been a great vehicle for companies to grow, particularly at the early stage, but oftentimes at the later stage as well. So in the last 10 years, Lighter's provided over $200 million to over 400 companies. Most companies take multiple loans. And there are some companies that use Lighter Capital's funding to grow to very large sizes and decide to never take any dilution. So we are backed by Silicon Valley Bank and National Australia Bank and a couple great VCs in the US. As I said, we launched in Australia at the end of last year. It's going really well. We've funded 4 companies here so far. I'll tell you, I think the best way to describe the product and how we help our companies is to talk about some of the companies that have actually taken loans from us. So because there are different types of companies, and I put them into 3 buckets, but there's really more, and some of those buckets cross over. And the first bucket is the entrepreneur who just does not want to take any dilution, maybe dilution now or dilution ever. They don't want to bring anyone else onto their cap table, at least not at that stage. So they're not interested in taking VC money or angel money. And the next might be a company that is just too early for VC. They need to get some traction before they'll have VCs interested in them. I mean, people on this call probably know that VCs fund, less than 1% of companies that they look at. So a lot of great companies that need growth capital don't get funding from venture capitalists, and that's where we can come in. Another category that we fund to are companies who they might not ever qualify for VC funding because they're not going to be large. And from Lighter Capital's standpoint, we love the stories where our companies have grown to be unicorns. But the reality is, as long as they pay back the debt, that's fine. They don't need to become a billion-dollar company. So one of our companies that we funded several years ago is a company called Map Anything. They took 5 RBFs from Lighter Capital. Then they went on to get venture funding from some of the top venture funds in the US, and then they went on to be acquired by Salesforce. So they were able to get to the point where they could attract venture funding with very little dilution and really, a simple fundraising process. To get a loan from Lighter is a matter of filling out our application, which takes maybe a couple hours at the most, 1 or 2 phone calls, and companies can be funded in as little as 2 weeks. Another one of our companies is Fishtown Analytics. Fishtown Analytics is a company, it's a little bit later stage compared to when we usually come in. Fishtown Analytics, when we funded them, they had taken some angel money and they had grown to 3 million sorry, this is Seamless AI. Let me go back to Fishtown Analytics. Fishtown Analytics, it was an early stage company, and we gave them $240,000 of funding. This was in 2019. They used our non-dilutive funding to raise money from Andreessen Horowitz. And recently which is one of the top venture funds in the world, and recently they did a $30 million round that was led by Sequoia, another one of the top venture funds in the world. So they were able to get a relatively small loan from Lighter Capital of $240,000, no dilution, get to a point where get enough traction where they were able to attract funding from one of the top venture funds in the world. Another company that we funded not too long ago is Seamless AI, and that's the one that's a little bit later on. They were about 3 million in revenue when we came in. They had taken some money from friends and family, and they were able to, we gave them multiple loans, and they were able to get from 3 million in revenue to 25 million in recurring revenue without any dilution, because that was our funding that took them there. And they are now doing a very large round with a private equity fund, where the founders are taking tens of millions of dollars off the table. So again, the founders got there. It's a husband and wife team. They got to that point with hardly any dilution. And then another example is a company that we funded back in 2013. We gave them an initial loan. They got some venture money and grew, but didn't grow enough to attract more venture money. So 3 years ago, we gave them another loan. They were able to grow a little bit, and they're just on the cusp of maybe some big growth, but they're taking another loan from us to work on some partnership opportunities that they have. So it's a good opportunity when even when for companies that are potentially in between funding. And in fact, one of our largest sources of deals or referrals comes from venture capitalists. So I know from being a venture capitalist for 20 years, you hate saying no. I was also an entrepreneur, and you hate saying no to companies, but your job is to say no 99 times for every time you say yes. So a lot of times we'll see great companies, and every venture capitalist has a story of wonderful companies they've turned down. And especially when I was at NAB, it just there were a lot of great companies that weren't necessarily a fit because we were looking for a strategic fit for NAB. But we get a lot of referrals from venture capitalists because a lot of time, you don't want to say no, but if there's something that you can, as a venture capitalist, provide to the entrepreneur that's useful, like another place they could go to potentially raise that growth capital, that tends to be, something that's worked really well. So I think that probably gives a good idea of what Lighter does. Again, if you're a SaaS company or any company with recurring revenue, our website is lightercapital.com. Feel free to reach out to me directly. I think I probably covered most of it. So thank you, Deborah.
Thanks, Melissa. Once again, right on time. Well done. Everybody's staying on time. I like that a lot. So thank you very much. Now I'm going to hand to Chelsea and Samar from Scale Investors. And once again, a little bit different again this time. Welcome, Chelsea.
Thanks, Deborah. Thanks so much. Hi, everyone. I'm Chelsea, the co-CEO here at Scale Investors. I'll just say an apology on behalf of Samar. We're both in Melbourne, and so she's doing homeschool, and she's got little one at home at the moment. So I'm just going to take this one for the team this afternoon. So Scale Investors, we are the main focus of our thesis is investing in female founders. I'll just preface my presentation with saying we absolutely do invest in male and female, co-founded teams. And so Scale, we're focused on early stage investments. So we're a network of angel investors. If we just go to the next slide, thanks, Alison. I might just start with, just some high-level facts around, why we focus on female founders. And maybe I'll start with a not-so-fun fact, being that, globally venture capital going to all female-led teams actually went backwards in 2020. So the stats are pretty dire, with less than 3% now of global venture capital going into female-founded startups. And so there's a few sort of high-level facts here and stats around, the why. But I might just keep going through the slide deck and maybe just share a little bit more about Scale. So as I mentioned, we're an angel investor network and we invest as a syndicate. So what that means is you get the benefit of an entire network of angel investors and we invest through a Scale unit trust. So you have one shareholder on your cap table with the benefit of multiple engaged angel investors. So we are industry agnostic and, as a rule, most of our investments have, that underlying technology that is making the business scalable. So our portfolio is fairly varied, being the fact that we are industry agnostic. And the reason behind that is because our investors come from a really wide range of experiences, skills, careers and backgrounds. And that's really reflective across the portfolio. Angel investors tend to invest in what they know. And that's the reason behind that is, they're running their own due diligence alongside, the support and the facilitation that Scale as an organisation is providing. The angel investors, they really want to provide that in-kind support and that quote unquote smart capital to an early stage investment. And so what that means is, we're obviously investing capital first and foremost, but we're leveraging our community of angel investors to really lean in and support founders and early stage businesses where we can. So really my number one tip is, when you come to an angel network, Scale specifically, come with your wish list outside of capital because you'd be really amazed by, the power of a network. And in most cases, I'd say 99.9% of times, there's someone who tends to know someone that you can connect with in terms of, a door opening opportunity or a mentoring opportunity or whatever it may be that you're looking for. So I mentioned we're participating in seed capital rounds. So essentially breaking down the jargon, that's that first check coming in. We do invest alongside early stage venture capital firms, VCs, but in most cases, the deals that we're working on, we are sharing the load with other angel networks, and there are more and more popping up across Australia, which is great for the ecosystem. So we're averaging, our check size really ranges. We start from 100,000 and we go right up to north of 500,000. And so the commitments within a check that you receive will start from around $10,000 per investor. So you can imagine that sort of compounds, cash on, investors, and you build out your network of support as you build out a syndicate with Scale. We'll just go to the next slide, Alison. I'll just touch on, how we source deal flow, but, there's multiple ways that we're attracting and engaging with founders. In most cases, there's some sort of warm referral. So we work really closely with accelerators, other investors, VCs, other angel networks, which I've touched on. And from there, we're bringing in a deal opportunity to our network. So I'll just probably keep moving from here. When it comes to assessing an early stage startup, there are many areas that we're looking at, and in most cases it's not necessarily a revenue hurdle that we're looking for companies to have met. We are coming in really early, and in some cases the businesses are pre-revenue. So first and foremost, we're really assessing and getting to know and understanding the ability of the team. In most cases this is the core of the business at the very early stage. So I think another investor very early on mentioned, getting to know your investors early on. We love to follow founder journeys. We love to engage with founders as early as possible, and really be taken on the journey. And that sort of forms the first part of our due diligence. I mentioned before, we don't have a revenue hurdle when it comes to traction. There are many ways of showing traction and illustrating your metrics in terms of any contracts you've got in place, a validation from the market, and any pilots, paid or unpaid. We love to chat to your enterprise pilots or whoever it may be to get an understanding of their feedback, and that's sort of a way that we look at traction if there is no revenue at that stage. In terms of equity, because we are focused on female founders, we really want to understand that the female founder has equal or majority shareholding in an early stage company. It's okay if there are other founders on the cap table. We just want to understand that there's an even equity split. And at the early stage, we're looking at founders maintaining as much equity as possible. So typically we're seeing at the early stage founders raising a total of no more than 20% equity in the round, and in most cases we wouldn't take up that entire round. So I think I mentioned before that we definitely co-invest, and where we sit as a network and as a shareholder, our sweet spot's anywhere from 8 to 10% equity. And then we do look closely at that valuation. However, that is a bit of a sliding scale from what we've seen over the years. So anywhere from 2 to 10 million is sort of a general trend that we're seeing at the moment in seed, which is quite a big leap from one to the other. And so we do look at each deal, the market, and what that means for founder dilution at the time of raising. So just moving along to the next slide. A little bit on a process. Now, because we are a syndicate, we do run a fairly structured process. You can take all of these timings with sort of a grain of salt. No two deals are the same, but essentially, we like to meet founders one-on-one, get to understand who you are, what your mission is, and what you've built so far in the business. When you're ready, we ask you to formally apply through an online portal. Again, we're not asking for too much information at this point. Just the reason we're asking for an application through a portal is so that our syndicate of investors can view the deal opportunities in our pipeline. So every other month, we're holding an investor forum or a pitch session. So we'll invite a short list of companies to present and pitch for investment at this session. And from here, we start building the syndicate of interest. And so then we progress through, a process of due diligence, and that's really dependent on, where you as a company are at in your capital raising journey. So we can definitely lead that process of due diligence, and in most cases, we'd round that out in about 4 weeks. If you've already done a comprehensive due diligence process with another group, we can definitely condense our process to align with the work that's already been done and the terms that have been set. Just touching on, the structures of deals that we're looking at, we invest for equity. We also do convertible notes, and we've seen a big trend towards SAFE agreements for early stage companies, and the acronym for that broken down is Simple Agreement for Future Equity. So it's a really nice mechanism for a really early stage company that sort of aligns with a convertible note structure. I will keep moving along because I think I'm running out of time.
1 minute.
Here's just a quick sort of overview of the female founder landscape in Australia, but I might just whip through that and maybe just touch on my last slide, which is our current portfolio. So as I mentioned, industry agnostic. We don't have a RegTech investment at the moment. We do have a couple of insurtech businesses. We've got a couple of medtech businesses, and like I mentioned, that's really a reflection of who's who in our network. I'll just quickly touch on our network. So we've got professional service investors. We've got founders themselves that are now investing. So we've really got a wide mix of skills and experience that we can connect founders with throughout any stage of the process. So I will just wrap up there, and thanks very much. Happy to answer any questions.
Thanks very much, Chelsea. Well, we might move on to our Q&A, and I know Melissa has a hard stop, so perhaps I might divvy up the questions. And the first one was Steve Champion, who's asked, and maybe I'll throw to you, Melissa, so you can answer this before you have to leave. But he was asking about the difference, and perhaps he was asking for a legal difference. But I know that you sat on the board of the Australian Investment Council for a long time, which was made up of private equity firms and venture firms. So you spent time with the whole gamut. What's the difference between VC and PE?
Well, I will say that in my 20 years in this industry, the lines have blurred, but typically you would think of PE coming in for more mature businesses that are already profitable, taking a controlling stake, if not buying the entire business. But like I said, the lines have completely blurred, and VC would be taking a minority stake. Typically the companies are not profitable, they're still investing in growth. And so it's really a stage. And also you're not going to necessarily, you don't typically see VCs in non-tech companies, where you will see private equity come into non-tech companies as long as there's cash flow to support the investment.
And is it true to say as well that VCs tend to invest more in life sciences and biotech and that kind of thing?
Yeah, absolutely.
Yeah.
And just in tech, well, tech in general, although again, you know, if you'd gone back, I mean, we're seeing a lot of private equity firms invest in later stage, and even some of them early stage venture these days.
Yeah, right. Okay, that's great. Clayton, did you have a point because they did ask for a technical legal difference? You're on mute. You're on mute.
I think Melissa's covered that quite well. I guess, yeah, the only thing we see is probably, yeah, a check size and a check size and kind of a timing aspect as to when they invest, if you kind of want to take a step away from it. But no, I agree with everything Melissa has said.
Yeah, fantastic. So another question for you, James, is you know, you mentioned the list of things that founders should focus on, but in particular around streamlining the investor due diligence process. What's your top 5? Can you think of 5 things?
Look, I probably wouldn't even say 5. Look, the most critical thing we see is making sure that those documents are collated and they're readily, and you have them to hand. Because the thing that we see that slows down DD is kind of asking for the right documents. So there might be, you know, some early documents which have been replaced, for example, by later ones. Just making sure that they're collated, readily accessible, and they can kind of be dropped into any form of kind of online data room that could speed up, the investors' review of those. That's probably it.
Yeah, great. Thanks very much. So Lisa Schutz from Verifier TED has a question, and it's got multiple parts. So your challenge will be to answer this in less than 2 minutes. She's interested in what registry consolidation looks like when you go in and you mop up the seed investors while you take a significant stake on the registry. Is this a common approach, is the first question. And the second question is, do you have a ratio that you work to, as in X% of investment to business, rest to buy out existing shareholders? And then she says it sounds like it helps on timing issues since those early investors are often ready for an exit earlier than the founders.
Right. Can you hear me now?
Yes.
Okay. Typically, we would only see this in, I would think, I would be guessing 1 in 4 of our investments, because we tend to be coming alongside just founder groups with a few family and friends might have been in there. But, you know, say 25, 30% maybe of the deals we see a slew of investors and there's an opportunity to clean up the register. As to the percentage of the capital injection, it really depends on the growth stage of the company, but I would think less than 40% or less of the capital that would be injected, because at the end of the day, we're trying to grow the business, would go to retiring existing investors. It does provide a nice timing issue for early stage or seed investors, but they've also got to be, one of the challenges always, whether they're realistic about the multiples they're getting on exiting, having been in at a seed stage and exiting at only 1 or 2 stages later, the multiples they would expect for the equity that they've contributed. So they might be getting 2x, but they're certainly not going to be getting 7 to 10x for something typically, and 10x times their money. So it's a difficult one to navigate. I think it's becoming more common. Our philosophy is not to go into an investment simply because we're going to retire existing investors. It's about going into investment because we see significant growth opportunity there, but to get to the level of equity we would like, we'll take out other early stage investors in whole or in part, and that also minimises, frankly, the number of people who have a right to say no on the raising of subsequent rounds or to pivots or changes in strategy or M&A. Whereas you really want to be able to, if you've got a substantial stake, to sit alongside the founder and make those decisions without the tail wagging the dog of investors having some sort of veto right, which often does happen. So hopefully they've been to see Clayton before when they're doing these investor agreements, so you don't end up in a situation where you're held to ransom by a very small minority investor.
Thanks, Ted. Melissa, before you have to go, I thought you might have a comment on this, and then I'll pass to Chelsea. I'm sorry, Sally, we are dreaming up a question for you. We'll get one for you. But Jasper Pose works at the Commonwealth Bank and he's also on our board, and he says here that he loves that Scale is funding female-led startups. But how can the broader ecosystem, including policymakers and government, further propel more female lead startups and get funding for their companies? And I just thought, Melissa, you might want to comment on that because I know you've got to go, and then we'll hand over to Chelsea.
Yeah, well, one of the first things that I did when I took over as CEO at Lighter Capital is I looked at all of the companies we've funded. So like I said, we've provided over 800 loans to over 400 companies. And I looked at the gender balance on the executive team and looked at how that compared to, you know, what I had done historically in VC and what we've seen historically funded in VC. And not surprising, it was a lot higher on the debt side. So 20% of Lighter Capital's companies were either, that Lighter Capital has historically funded, because they're tech companies, sadly it's still mostly men, but 20% were either had a female in the lead or had women on the leadership team, which is higher than you see in venture. And the reason for that, I'm convinced, is that when we make our funding decisions, they are 100% data driven. We are looking at the numbers and deciding how much debt we can provide this company. As a venture capitalist, and most venture capitalists will say this, the most important thing is the team. And that is not something that's typically driven by data. That's much more of an art than a science when you're making that decision. So, and there's so much unconscious bias that goes into, you know, the quality of the team or how capable the team is. And I even had this unconscious bias as a CEO, since you're used to seeing one thing, a success, you're seeing one view of success, you know, that's what you tend to gravitate towards. And I do think that's changing in Australia. I know since we started Heads Over Heels 10 years ago, we've seen big changes. And really, if you were sitting in Australia right now making investments and you'd only been here the last 10 years, you might think the best place to invest is in female-led companies, because our most successful unicorn right now is run by a young female with Canva and Melanie Perkins.
Yeah, well put. So just quickly before you have to rush off, Ted has asked a question of you. Is formal security required over cash flows for the revenue-based financing?
No.
That's no, Ted.
Thanks.
There you go. So I might hand over that same question to Chelsea, just in relation to, policymakers, government, and what more can be done about, female founders and getting the capital to them. Do you have something to add there before we round out a question to Sally?
Yeah, absolutely. I guess sort of echoing Melissa's point around unconscious bias, and there's not necessarily a lack of female founders. I think there's a gap and a lack of female investors. I think I mentioned, multiple times in my little pitch that investors at the very early stage, at least, tend to invest in what they know and what they resonate with, and the problem, that they really want to understand the problem and therefore the market. And in some cases, not all female-led businesses are solving, quote unquote, female problems or female gaps in the market, but there is a very large percentage that are. And I think perhaps there's just a mismatch in understanding on the investor side. It's unconscious in most cases, I believe, but we are also focused at scale on, building up our network of female investors. At the moment, we're probably about 75% female investors, 25%, which is great. And we love the male investors. Diversity of thought is absolutely key. But I think the biggest, maybe piece that's holding back female founders for even asking for capital is they don't particularly feel comfortable or empowered to go to, male-led VC firms. Just because there's potentially a mismatch in understanding the problem. And someone's put in the chat here the Boosting Female Founders Initiative, which is absolutely fabulous. At the federal level here in Victoria, there's just been an announcement for the Alice Anderson Fund, which is powered and backed by LaunchVic. So the Alice Anderson Fund is a $10 million fund for female-led businesses to apply for matched funding. So they provide, they'll be providing match funding once a seed round is completed with private investors. So that's two great initiatives that have been rolled out in the last 12 to 18 months, supporting female founders in the ecosystem.
Yeah, that's great. Thanks so much for that. And Sally, we do have a question from you from Lisa Schutz from Verifier. The functional area that your companies most ask for help with, what is that? Where is that?
So I think, we often work with founders and founder-led businesses who have a remarkable story and have built remarkable businesses. And so as a result of that, I think there are many things that have sort of been deprioritized, if you like, because it was never really important, or because they didn't require it in their business historically to grow. And so I think from our perspective, we often see the two, I would probably call out two, and those two are probably one, sales force effectiveness. And that's because I think when you are scaling a business, the mentality is if we keep selling, we won't have a problem, we will continue to grow. And they have been selling, and because they have a great product there, but it isn't necessarily optimized. And in private equity, it's sort of dangerous to make generalizations, but at least at Potentia, we are very data driven. So when we go in and we analyze historical sales, and when we analyze the pipeline and we analyze conversion, and sort of come up with insights, there are lots of things that sort of are a surprise to them, and they go like, how did we not pick this up, or and things like that. So I think that's probably one. And two is probably the financial side and the data side. As I say, I think we sort of we look for KPIs at the board level at the very least, and in terms of tracking your business and as sort of a health check on how it's going. And I think that historically, again, that mentality of if we keep selling, we will keep growing, that's not necessarily been put on paper and, been analysed historically a lot of the time. And so I think businesses often come to us and sort of require a lot of help building up that function because it's just historically never necessarily been important.
I'm just looking to see whether there was, sorry, I just thought there was another question there. I was going to say, you know, the importance of being aligned on a number of things and having a, how important is it that portfolio companies, your investee companies, you know, have good cultural alignment and also have good alignment on around things like the exit. So I know that founders often aren't thinking necessarily about the exit. They're still thinking about all the bits in between. So how important is it to get alignment on that? And actually, how important is it to be thinking about it even now?
I think it's absolutely critical because it kind of goes to how we become partners on this journey towards exit. I think at the very start of the journey, you know, our mandate as private equity, we sort of look for investment holds of sort of 3 to 5 years, I would say, generally speaking, and that in some ways is potentially a little bit shorter than sort of venture capital funds. So that is the horizon, and that is, you know, that there is a alignment there. Then that's great. And in terms of culturally, I think, you know, we will sort of be, as I say, our operating partners, and this management team will be working very closely hand in hand. We are all sort of, you know, sitting in the same board meetings and sort of working in partnership. And so even within, on a personal level, I think that cultural alignment is very important and something that we assess throughout the due diligence process from day one.
Yeah, yeah, absolutely. So I might go around the virtual podium and just ask for a final comment from each of you, and if you can keep that brief, but and I will send to each of you the list of those that have opted in to provide their details so that you'll know who is on the line, because I appreciate that's a bit of a mystery. It's a bit of a mystery to you right now, but I will send the list. So Ted, you're at the top of my screen, so I'm going to ask you for a final brief comment.
Yeah, look, first of all, I enjoyed the session and I'm learning. You continue to learn every day. You see other investors at different parts of the market, and then the sort of questions also that founders are making. I think what's good with the RegTech Association is you're providing a forum for people to access capital at different stages of their life cycle and access input and advice and experience at and most people who participate, either as speakers or attendees on these forums, typically open to lending their hand. And I think that's what I you know, which is commonly known as paying forward a bit, giving a bit of your free time, a bit of advice without putting it through a formal process, even if we might not be the right person for you at that time. I'm certainly open to people coming, and I'm sure Sally and others here on this call, Melissa, would be happy to share their experiences, because you've got to build your own pipeline of potential investments and businesses. And by meeting them and sort of following them over their journey, it's a benefit to both of us.
Yeah, absolutely. Well said. Sally?
Look, I think this has been great, and I think it is a super useful forum for us and for all those on the call. I think the message that I would sort of leave is it is never too early to start thinking about these things, and you know, I think don't underestimate the amount of preparation that it takes when this is, you know, one of the big decisions in your life. And so I think what really excites us and about, you know, RegTech in Australia is that Australia really punches above its weight in technology and in RegTech in terms of our size relative to the rest of the world. And I think that's really exciting for us because forums like this really sort of elevate that conversation and promote investment into this space that can really sort of shape technology in the future.
Yeah, thank you. Well said. I think I need to put both Ted and Sally on my sales team, because Sally's just quoted from our research that shows that we are punching above our weight, and Ted is a very proactive member, sending out the good message. So thank you both. Now, we'll finish off with you, Clayton. So Chelsea, a final comment from you?
Yeah, thanks, Deborah. Thanks everyone for listening. Yeah, I think, you know, it's never too early to start the conversation. So yeah, encourage anyone who's, you know, thinking about raising that first check, to reach out to me, or I can reach out to you. Yeah, we hold monthly office hour sessions where you can hear more about process. We're very open to, you know, like I said, you know, chatting early on, connecting founders to investors who might be able to provide support early on in terms of, you know, getting that introduction to that enterprise that you're working on, or whatever it may be. You'd be surprised, yeah, how supportive and how you know, how generous early stage investors are with their little black books. So don't hold back.
Thanks, Chelsea. And the final word goes to, well, the final word will come to me actually, but you'll get the final word from the panel, Clayton.
I'll keep it very short, Deborah. And it's something I touched on before. It's what we always say to our clients is, if they are going through the fundraising journey, what you're doing during your current fundraise is really solving for the next one. And just to keep that in mind as you go through that fundraising journey, and making sure, as Ted's good point, keep an eye out for things like, vetoes over future capital raises and things like that. Keep that in mind. Obviously, keep the cap table updated and accurate. Is another one to throw in there as well.
Thanks very much, Clayton, and thank you, Ben Hobby, for giving us a nice shout out there. And in fact, Ben was the CEO of a company called iTree that were acquired by Objective Corporation. So there are great Aussie RegTechs out there for you to invest in or look at acquiring. And the other thing I would say to the investors on the line today, we are launching a whole raft of these same showcase programs, except the other way. So you'll get an opportunity to come and have a look at all of the RegTech companies. We don't give them as long to present those, so they only get 5 minutes. You were very lucky; you got 10 minutes each. They will get 5 minutes, and we've kicked off that series already. We've got an AML one in a couple of weeks' time. And just picking up on the point that Ted made about giving back, next week I just want to give a little bit of a plug, and it's a members-only event. Where I've invited one of the co-founders of a company called Docs Corp, and his name is Dean Sappy. And some of you may know Dean, but he has just sold his business for more than 100 million US dollars. And it was a software company that solves for a very simple but very problematic area in the legal fraternity as well as in banks. He kept his product, very, very simple, was able to scale the business and is now being rewarded. But speaking of giving back, I was connected with him and he said, look, I'd love to come and share all of the bumps and the tips and the traps that I have had as a software founder with your community. So watch out for that next week. And Alison's put up a lovely slide there of some of the other things that we've got coming along over the next couple of weeks. So I would like to thank the presenters today very much. Look, there we are. Look at that. Isn't that amazing? We started with about 8 4 years ago, and we now have 180 organisations. And so, as you can see, some of the biggest companies in Australia and some biggest companies in the world, actually. So it's very gratifying. If you're online and you're not a member and would like to join, there's the link. And I really look forward to seeing you all and then enjoying hearing from you as you are making connections with these investors that we've had online today. So I will call a formal close to proceedings. You can feel free to log off. I'll stay on for a minute or so in case anybody would like a chat. Otherwise, cheerio. See you next time, and thank you all very much.